Major funding for this program is made possible by grants from Bank of America and Perfect Building Maintenance, GREENBERG TRAURIG, LLP, New York Community Bank, Kilroy Metal Products, New York's Window Company, Capital One Bank. Additional funding for this program is made possible by grants from Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, CUSHMAN and Wakefield, First American Title Insurance Company of New York, F.J. Siami, FRIEDMAN, LLP, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, James D. KUHN Real Estate Institute at Syracuse University, James Orphanides, Madison Realty Capital, Meridian Capital Group, M&T Bank, Massey Knackle Realty Services, Muss Development, Newmark Knight Frank, Sterling and Sterling, Stonehenge Partners, the MOINIAN Group, Urban American, W Financial Mortgage Fund.
Hello, my name is Michael Stoller. So we're here, it's the fall of 2009. We're still in a little recession, even though Bernanke says that we're not in a recession. There's not too much money for real estate, but on a selective basis, certain banks and certain lenders are looking at real estate transactions. So today I've assembled four prominent bankers who are heavily involved in real estate and also the commerce and industry of lending to describe what they're doing, what they like, and what they don't like. My guests today include Dan Harris, Executive Vice President and Chief Lending Officer of the Dime Savings Bank of Williamsburg, Greg Fierce, Executive Vice President of Commercial Real Estate of the Amalgamated Bank, John Manginelli, Senior Vice President, Regional Head of Commercial Real Estate, Northeastern Region, for KeyBank, and last but not least, the new kid on the block in this venue in banking.
In this venue.
Okay, but not a new kid on the block in banking. Randy Nielsen, Executive Chairman of the Board of Herald National Bank. So since you're the new kid on the block, on this side, I mean, you were the president of Reliance Savings, you know, going back over there. What do you see today, and what is Herald doing? And, you know, since you are the new kid, you started in, it's going to be close to a year. November 2008 will be your 1 year anniversary that you went into business. You like real estate. You've always liked real estate. Your father liked real estate. You like real estate. Okay, so are you lending on real estate?
Yeah, we're lending on real estate, but we're lending on real estate the way we used to lend on real estate, where we're underwriting the real estate, and we're not only underwriting the real estate, we're underwriting the borrowers as well at the same token. So sure, we're looking at deals selectively, cautiously. As a new kid on the street, we can't afford any mistakes.
See, people say you have no bad loans because you started late.
I would hope not.
No, I hope not also. But the key is, you know, unfortunately, as we were saying prior to the show, Dan and I and all the jokes, is that you're the new kid on the block, so some of the lenders, good, bad, some of the borrowers, good, bad, and indifferent, and some of the mortgage brokers say, hey, this is the new kid on the block that we can go after, right?
Yeah, well, Mike, we have no bad loans at Herald right now, but I've been the proud owner of some bad loans in past experiences in past banks that I've been with. So, you know, decided to come back into banking at an opportune time to amortize some of that scar factors and aggravation that we've been through in the past, and maybe play with some of those skills again.
No, I'm confident, and I know you're going to do well in that. John, you've seen banking over the last 25 years, a variety of places, Summit, Fleet, you know, KeyBank, and so on. How do you see the market, and what is Key doing today? You know, because we said prior to the show, you're in business and you're selectively picking on the right clients and the right assets like Randy. So what are you doing?
Well, I think what you said, that that right client base, I'm sure most banks have identified those are retained clients. And I think, you know, for putting aside right now the wonderful opportunities that will be for prospects, I mean, our focus clearly has been on some balance sheet relief, clearing up the balance sheet, and completing transactions for those good core retained clients that have used Key's platform. Key's got a great platform. Part of the reason I went there, the permanent loans that are available today, Fannie, Freddie, FHA, that's been a great off-balance sheet outlet for us. Our credit tenant lease program has been a great outlet for us, as well as our life company placements. So we're really steering any of that balance sheet relief we can off our balance sheet to clear up the balance sheet, to really create more of that capital for us. The existing clients that have those needs, frequently multifamily.
So for my audience, because you know, I don't want to play inside baseball.
Right.
Fannie, Freddie, and FHA. Let's explain what that means to the people.
The agency lenders, Fannie Mae, we've all heard of, Freddie Mac, and the Federal Housing Authority, FHA, you know, those provide financings for the commercial properties, multifamily, primarily. Might be a little bit of mixed use, might have some retail in there. The apartment buildings here in New York, Washington, Atlanta, all of my markets in the East, they've been very, very good quasi-governmental support. You know, that's been a good exit for some of the deals that are on the balance sheet. Our CMBS, our commercial mortgage-backed securities market, has really closed up for the time being. So really, as the banks like ours that may...
So if we had a construction loan or we have a multifamily, you might take the deal and then sell it off later on to Fannie and Freddie for your borrower.
That's what we would do.
That's exactly right, what you're doing. Now, Greg, you know, we were joking before, the amalgamated bank, people of older age would remember that Stiller and Mira were the commercials for Amalgamated, the Union Bank, you know, which is still the Union Bank. What's the Amalgamated Bank, who, as you said, and which I quoted on 1010 Wins, you got lots of capital. What are you doing with all that money you have out there?
Well, I think there's an opportunity for us, because I sort of consider us a new kid on the block, because my team joined Amalgamated in 2007, and we began to build a commercial real estate lending portfolio by expanding the product mix, by entering the construction lending area and growing some of the existing businesses there. So there are a handful of customers at the middle market level that are currently not being serviced by many of the larger banks. And so, armed with some capital and now the skill set, we're going after those clients. So we're going after those relationships, we're going after the business, and that's where we're generating the activity. And there is clearly a void there to be filled, and we're currently trying to fill it. And we've had some success doing that. We started off with a bang in March of 07 and did a great book of business throughout 07. And as we all know, the first quarter of 2008, you know, everybody kind of hit the brakes a little bit. So now it's pick your spots, pick your clients, pick your spots, pick your products, pick your markets. So that's what we're doing.
So Dan, you know, we have new bank, a year old. We have another bank, you know, based in Cleveland, but a national bank over here. We have Amalgamated, who does business all over the country.
Yes.
And then we have the Dime Savings Bank of Williamsburg, a bank who's been around since the mid 1864, who even got the other Dime name. So you have which is great, because people remember the old Dime. Yes. There's no question. And you've been pretty active. What have you been doing?
We've been very active. We're a New York City multifamily lender primarily. That's our focus. We love rent-regulated buildings, and there's a lot of business there. Right now it's primarily refinance business. There's not a lot of conveyancing going on, because there's still a big gap between what the sellers think their buildings are worth and what the buyers will pay and what, you know, banks will finance. But there's a tremendous inventory of loans that are coming on to 5 years old. Most of the paper is 5-year maturity or changes rates in 5 years. So that business is really what everyone's focused on in our space right now.
You know, you bring up a good point about the 5-year paper. For my audience, a 5-year loan is, you know, there's a 5-year loan, and then you have the option to renew the loan for 5 years. Right. The situation was the 5-year loan was always tied to some basis, right, a certain number. Right. You know, it was tied to the 5-year Treasury note. Now the only problem is, I mean, the problem is for the bank, because the Treasury rate may be too low for you to want to put it on the books.
Yeah, most banks either tie to the 5-year Treasury or the 5-year Federal Home Loan Bank rate, which used to run about 0.8% higher. Now it's closer to 100 basis points, and on a 10-year it's even higher. So fortunately, our reset math for the second 5 years is based on about 2.5% over the 5-year Federal Home Loan Bank rate, which is higher. So that number right now is right about what our market rate is anyway. So I mean, this is the first time in the past 6 or 7 months that we've actually had deals roll into the refinance. Previously, the borrower would always come in, they'd try to cash out a little bit, they'd take it to another bank to cash out and get more money out of their properties. For the first time, they're just taking the roll, and that's really a unique environment. That's new to that business.
You know, with regard to that, are you saying that borrowers are becoming more cognizant of the world today, or are they still, you know, in 2006, 2007, you know, and you saw it when you were in North Fork over there, you know, people were coming in there and said, hey, you know, I want 95% the purchase price, I want 100%, you know, and then I want more money, you know, whatever it is, because there were people out there, real estate investment funds and other people, who were paying everything because they thought rents were going up. Would you say the borrowers are
if they're not, they get real cognizant as they get close to that roll rate.
Right.
You know, that's a real wake-up call to a lot of people at some point today.
But you know, you bring out, I mean, when you were at Reliance and then at North Fork,
right.
I mean, you saw the 90s, you saw the 80s, okay? You saw the 80s, you know, with the, you know, where houses were built in Long Island and picked up overnight, and then in the 90s the world changed over there. How do you view the market today in your banking career?
Well, it's to me it feels like it's a little deeper, and it's going to take a little longer to come back out, and I'm not so sure that it's going back to the way things were or where they were. I think, you know, I hope people's expectations and projections for the future on things is maybe a little different. You know, I think we have a tendency to forget what we learned sometimes as soon as things straighten out. But I mean, you know, those of us and all of us here are bankers in maybe different regulatory agencies, but those regulators have learned a lesson, and they're penetrating down a lot of control mechanisms. And
you know, you bring up a very interesting point. Some other banks who I've spoken to have basically said that, you know, some of them have some bad loans, and the regulators are really stymieing them, not allowing them to do anything. I mean, some of them would like to do some business. You know, they got the federal regulators, they got the state regulators, they got all these people there. They say one leaves this week, another one comes in over there. I mean, and it's that situation. How are the regulators looking today at your lending criteria? I mean, you know, at one time, you know, are they looking at the borrowers more? I mean, because in multifamily, as we all knew, you know, you were looking at the asset, you were looking at the building. And you said, you know, if the person didn't have any negatives on their financial statement, they never tax lien, or they were an upstanding person, fine. You didn't really care about the financial statement. You know, are the regulators looking more today?
Depends on how strong your bank is. The stronger your bank is, if you're Camel 1, which is a common rating system of the regulators, 1's the best, 5's the worst. If you're a Camel 1, they're going to be much easier on you. They want to see your policies there. Your non-performers are relatively low. If you're Camel 2, you're probably okay. Once you just get into a Camel 3 or worse, they're all over you. They're going to be much stricter about your new lending. They're going to want to shut down your new lending probably because they want you to focus on your problems. So, I mean, if they feel good about you, they're going to let you continue to do business as usual. If, however, they see weakness in your existing portfolio, you know, they want your focus there, and that's what they're going to focus on.
You know, but, you know, you talk about these Camel ratings, which, you know, my viewers won't understand, but we will understand. But there's another interesting thing. Over the past couple of years, a couple of banks in New York, none of them here and none of them have ever been on my show, are under what we call cease and desist orders right now. And two of them, specifically two of them, spent a lot of their business in real estate lending.
Right.
You know, one was a new kid on the block, not with the senior management of Herald, you know, who went into business in 2005. The chairman was on my show. I did his life story, you know, and they put out $250 million, and probably most of the loans are in trouble. And the other one is another real estate guy. As someone said, sometimes you could be in the real estate business, but you can't be in the banking business. And that's the circumstance with these two banks over there. And I assume before the end of the year, I hope that they aren't taken over by the government, but they could be taken over by the government.
Well, when you think about it, one of those banks in particular entered the market during the height of the CMBS activity. So they had to structure their deals pretty aggressively to compete and build their book of business. So they actually engaged in that. And at this particular point, that's coming back to bite them. I think in our colleague's case here, he's building his book of business, but he's building it in an environment where caution rules. Yep. We're back to the old underwriting standards. We're really looking at customers and assets. So it's a very different
I agree, but I was really trying to bring out, sometimes people go in there and they think they could be a banker when they're not in that business.
Hey, even we bankers are best when we stick to our knitting and stick to what we understand. And when real estate guys try to become bankers, they're very bright in their own arena, but there's whole different levels of risk and public company risk, regulatory risk, all kinds of reputational risk, things that we have to weigh into what we do.
Mike, to your question, the regulators, the OCC are looking at our own bank policies, the loans that we have, and a lot of the developers, global cash flows, and their asset base. So they are really demanding a lot more portfolio management. I mean, we see it, irregardless of any of the ratings, being one of those banks, in the top 19 that got TARP money, there's probably a strong focus for some of the larger banks that have large real estate exposure like we do. So we really do have them in there. And we feel pretty good about working with them, but they are probably doing far more due diligence investigating for the full relationship, the actual asset and the developer.
Relating to this situation, okay, each one of you are lending. And I think basically each one of you has said, all of you like multifamily, because multifamily is rent regulated. You know that people have to live. New York City has this situation. There's a shortage of housing. There's a circumstance over here. So how about the other food classes, as we would say, in the business? New York City, urban retailing is done very well in New York, but retailing is dangerous because, when there's a recession, people don't shop as much. There's a situation. What's your thoughts about retail, lending on retail?
We've done some. We're doing a little of it. Most of it is geared towards our business model. And
so it's an owner-user, commerce and industry
It's an owner-user. There are a lot of other things related to the transaction, i.e. the deposit side of the relationship. There may be some different intangibles that are written into them. Definitely the criteria has gotten tighter. Everything has been ratcheted up, and we're not just I don't think anybody's taken for granted anymore the expenses that are presented, the future rents.
But when you bring out expenses being projected, I remember doing a show a couple of weeks ago, and also on my symposiums, the expenses of multifamily have gone up. In New York City, the water, and the real estate taxes have gone up higher than the rent-regulated situation. So even that situation. What's your thought on the retail?
The retail for certainly the grocery anchor type retail, in a dense, populated, demographic area, that is asset base that we will consider. We'll want to watch how much inline space there is. So if a developer had those two, that anchor and that junior anchor, and there was a tremendous amount of inline space, that'd probably be something that we wouldn't do. We've seen a couple of our developers on new transactions, more in my southern markets in the southeast, really decreasing the amount of inline space. One is actually using a credit-rated grocery anchor and actually doing that off-balance sheet through a credit tenant lease transaction, and we're financing the residual. So we're doing that off-balance sheet financing for them, getting a tremendous amount of capital for them, the loan proceeds, and having a small stub.
I mean, because retail, just look in our own market, Finley Fine Jewelry went bankrupt, Zales was in trouble, Stephen Barry went bankrupt, Fortune Up went bankrupt. You know, we've had a lot, you know, in Circuit City. So, you know, there have been this situation. And also there've been talk, but I think it's changed, you know, about Dwayne Reed, you know, because of, you know, the situation, you know, because of the competitive market.
Well, you know, as we discussed earlier, you know, our retail strategy is similar to our overall strategy. You first look to delever a little bit. So we're looking to our fundamentals to write retail deals that are at lower leverage levels than, you know, we may have been accustomed to in the last couple of years. And, you know, urban areas, grocery anchored, some recourse. Which is a word that you know, we didn't use a couple of years ago.
You know, for my viewers,
I don't want to be the one to bring it up.
Its way back in.
No, it's a word for viewers. It's guarantees. And one person said to me about a year ago, I never heard that word. I said, Norman, you've been around since '71. He says, that word left my dictionary. You know, it was something that's out of my dictionary. You know, what about, you know, there isn't much construction in New York. There's limited construction for office. There's limited construction for residential. Would you entertain a construction loan in today's market?
Well, there's a lot of construction finishing up.
Nothing's
new starting.
Wait, I didn't say there wasn't work.
Attempting to finish.
Finishing up.
There's a lot underway.
What? I mean, has the dime lent construction?
We have a handful of construction loans on our portfolio. Most are 70, 80, 90% done, and we're getting taken out either by condo sales. In a couple communities, condos are still selling at the right number. The rest are converting to rentals. And we actually have banks out there that we've discussed that are willing to take those loans out on a rental basis because they do rent up pretty well. Back to your retail comment, you know, we do like the strip urban center, suburban center, not with any of those large tenants, but with your regular guy.
But getting to my point today, would you look at a construction loan today?
No.
John? Not too many?
Very little for those core existing clients, as
Randy?
we've talked about.
It's hard to see in a lot of markets the real need for it, and you know the thing that I'm getting the flavor for from some of the developers is they don't even want to build themselves. They'd rather look around and look at the other assets that are available. Maybe
but you know, you bring up a very good point in a different manner. There are opportunities out there that a developer, a seasoned developer, somebody who's strong, has the opportunity to buy from the weak. I hate to say it's the strong versus the weak. Would you, if a developer came to you, a seasoned developer with a guarantee, with certain situations, and they want to buy a note, or if a distressed note, would you lend them money on it? I mean, you're the 19th largest bank. What? How big in the country?
About 100 billion. Oh, about the 13th, right.
Right, the 13th largest bank. I mean, would you lend money to a borrower to buy a note that's a distressed note of someone else?
We approved a deal today at committee just to do just that. It's a very convoluted deal, but we basically took an unsecured loan, bought a discount note from another lender, transferred that from unsecured to secured. So we look for those opportunities. We engaged some discussion with some equity sponsors and some borrowers who are buying distressed notes, and it's all a question of basis, and it's a question of break-even numbers. So if a condo went to market originally for $1,600 a foot, and the note has been turned around, and that number now works at $400 a foot, we're in.
I mean, but look at the discount you said. You're talking about a 75% discount.
We're in. You know, you can bend the numbers, but we're in.
Yeah, I think, Mike, you'd also
want to... my fingers.
That's right. You would also want to look at the exit. So is that client acquiring that note on a loan-to-own basis? Will they joint venture it? Does that note mature in the next 12 months? Because then you will have a pressure point
but
in
you know,
the deal.
you bring up an interesting point in that manner of, would you lend to somebody who just wants the interest or the loan-to-own?
Right.
Because I think perhaps
That's a good point.
the loan-to-own is the key, because then the person's going to stay in the deal to do the best for that property for later on, you know, where it is.
And they pay more.
And
they generally pay more.
No, we like loan to own.
You know, we didn't get to a subject which I have to bring out. It's getting a little better. I wrote an article about it, that the hospitality market is slightly seeing improvement in New York. Finally, they've seen occupancy has been up in September. It's getting better. The average daily rate is down. What's your thoughts about the hospitality market in New York? Since you're bankers, would you lend?
Well, you know, hospitality is very funny. you know, in my career, I've always seen hospitality very quickly deteriorate and very quickly improve. So, you know, the idea is
it's like it's like a restaurant.
Yeah,
Each
you know,
day, you know, the register closes, and you gotta rent those rooms.
So we have some construction loans on some hotels right now that, you know, we're like, thank goodness these things, you know, didn't get completed today. They're out in 2011 and beyond. So we might place some permanent debt on a hotel.
If it's running and operated with
got
history.
some track record, got some history, good management. Because as we always discussed, you know, the hotel business is not the real estate business.
It's a
per
true
se.
operating business.
Absolutely. So, you know, keep to those cash flows.
John,
Yeah.
Randy, anything?
You know, Key's really not been truly a big hospitality lender. In my former lives 10 years ago, did do a lot of it, worked very well, and in the New York market. So personally, there's some view of it. It's funny in that September 07 timeframe, we started actually writing some position papers to enhance and increase that business. And really, obviously,
Lucky the papers never got too
the paper
far.
never got published. So,
No,
you know,
you-
we
you-
really
you-
don't do
you-
a lot of that
you-
because it is a service industry.
You know,
We're a union bank, and one of our owners is the hotel union, so we obviously look at
right,
opportunities.
that's right. You're caught into that situation.
It may be part of a larger mixed-use project.
Yeah.
So, I mean, that we do have some of that, or there might be pads, so very little, though.
So you know, in summation, I hear 4 banks who are in business, one new bank who I'm certain has done great on deposits and is going to been growing by leaps and bounds. A bank who's been around since 1864, and I think that all of you are going to continue in business. And I think for my viewers who watch it on TV or on the internet, these are people you got to go to because they're good players. So I'd like to thank Dan Harris, Greg Fierce, John Manginelli, and Randy Nielsen. See you next week.
Major funding for this program is made possible by grants from Bank of America and Perfect Building Maintenance, GREENBERG TRAURIG, LLP, New York Community Bank, Kilroy Metal Products, New York's Window Company, Capital One Bank. Additional funding for this program is made possible by grants from Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, CUSHMAN and Wakefield, First American Title Insurance Company of New York, F.J. Siami, FRIEDMAN, LLP, GEMINI Real Estate Advisors, Hal Fettner, Durst Fettner Residential, James D. KUHN Real Estate Institute at Syracuse University, James Orphanides, Madison Realty Capital, Meridian Capital Group, M&T Bank, Massey Knackle Realty Services, Musk Development, Newmark Knight Frank, Sterling and Sterling, Stonehenge Partners, the Moinian Group, Urban American, W Financial Mortgage Fund.